Securitize added Sunil Sabharwal to its board, while its tokenized asset business moves closer to public market scrutiny. The appointment matters because tokenization is becoming a regulated infrastructure race, not just a blockchain branding exercise. Securitize SEC is the search angle, but this is not an enforcement story. It is a governance and credibility story around a company that manages more than $4 billion in on-chain assets for major financial institutions. The timing is important because board composition becomes more visible when a private crypto infrastructure firm prepares for public investors. A director with policy and payments experience can help answer questions that a pure technology team may not handle alone. Sabharwal brings a rare mix of payments, public policy, and cross-border finance experience. He served as a Senate-confirmed U.S. representative to the International Monetary Fund from 2016 to 2018. He has also worked around payment companies, financial infrastructure, and strategic growth. For Securitize, that background fits the problem it is trying to solve. Tokenized funds need more than a smart contract. They need transfer rules, investor checks, custody processes, and confidence from institutions that already operate under strict regulation. Cross-border payments experience is especially relevant because tokenized assets often move across jurisdictions. A fund token can be technically transferable, but the legal permission to transfer it still depends on who owns it and where they are allowed to trade. The company's business is already tied to some of the biggest names in traditional finance. Its platform supports tokenized products connected to BlackRock, Apollo, BNY, Hamilton Lane, KKR, and Van Eck. BlackRock's BUIDL fund is one of the best-known products in that category. A tokenized fund is a traditional financial product represented on a blockchain, so ownership and settlement can happen with digital rails. The practical promise is faster movement and better transparency. The practical risk is that compliance has to work every time. That is why tokenization is less simple than putting a fund name on a chain. The platform has to make old financial controls work inside a faster settlement environment. Securitize is also pursuing a public listing through a planned merger with Cantor Equity Partners II. The deal would value the company at $1 billion, and the combined company is expected to trade on Nasdaq under the ticker CEPT. It would also give Securitize access to the $240 million raised by CEPT in its initial public offering. Securitize SEC interest rises here because public market access forces a tokenization company to stand inside the same investor visibility as other listed financial firms. A Nasdaq path would also change the audience. Instead of only private investors and fund partners, public shareholders would be able to judge growth, revenue quality, and regulatory risk more openly. The key question is whether tokenization becomes market infrastructure or stays a niche product layer. Sabharwal's appointment signals that Securitize wants board-level experience in global finance and regulated payments as it scales. That does not prove the public listing will close. It does not prove institutions will move every fund on-chain. But it does show where the company thinks the next bottleneck is, not only technology, but trust, compliance, and distribution. The appointment also suggests Securitize wants credibility with institutions that already know the cost of compliance failures. In tokenized finance, a missed rule can damage the product faster than a slow blockchain. The next proof point is the merger path and product usage after the board change. If the Cantor transaction advances and institutional funds keep expanding on the platform, Securitize gains a stronger case as a regulated tokenization venue. If the listing stalls or usage does not deepen, the appointment becomes less powerful. Securitize SEC attention should be measured by execution, public market progress, more real-world asset products, and whether regulated investors keep choosing on-chain fund structures. The useful signal is not a press-friendly title. It is whether regulated capital keeps using the platform after governance, listing plans, and product expansion all become more visible.